Self-employed loans for people working for themselves. Anybody can need loans these days, whether a serviceman, a businessman, or a self-employed person. A self-employed is one who works for himself. Nowadays more and more people are working for themselves, which means they are self-employed. A self-employed person may have one of the following working areas: a sole proprietor, independent contractor, or a consultant. Self-employed loans are tailor-made to the financial requirements of people. Self-employed loans may be required by the self-employed persons for many reasons, which could be one of the following: for business purposes, debt consolidation, home improvement, or for personal purposes. Self-employed people all have different characteristics, which is why these loans are a little different from other loans. A prime reason for that is that self-employed people most of the times do not have any stable incomes, which are why they are offered certain perks where they can choose on how to repay. They are: 1. Overpayment. This feature allows the borrower the benefit of paying more than what is originally due as per his monthly installment, as the borrower may have earned more in that particular month. 2. Underpayment. This feature allows the borrower to pay less than what is due in that month, as there might have been less income than expected. 3. Payment holiday. This is totally different from overpayment and underpayment. Payment holiday allows the borrower to skip a limited number of payments after an initial period where the regular payments were made by the borrower. Self-employed loans are more risky than other loans for the lenders. So these loans require the borrower to make a down payment at the start of the loan term. This payment may be 20% to 40% of the loan amount. Due to these features being provided, the borrower gets charged a higher rate than usual in self-employed loans. The interest rates charged are between 10.9% and 27.60%. The average of interest rates charged is around 17.5%. Lenders, before providing the self-employed loans, assess the income of the borrower, as that is the most crucial aspect of the loan terms. Lenders may check the income in any of the two ways. Self-certification. In this case, the borrower gives out his income details himself and no proof of the income is required. But there are a few lenders who may want your audited accounts as well as your credit score. Audited accounts. These accounts will include your income details, which would have been checked by the concerned authorities. This method will give the lenders a truer picture of your income. On the basis of the availability of the income proof certificates, your loan can be categorized into a low doc or a no doc loan. A low doc loan requires very few documents, and a no doc loan requires no documents for the loan. Self-employed loans are available to people in both secured and unsecured loan forms. Another method of self-employed loans is HELOC, home equity line of credit. It is priced at spread to base interest rate. Self-employed loans are available to people with bad credit history as well. Credit history usually affects the loan amount ratio to about 70% 90%. It also affects the interest rates at which you can get the loan. Features of the self-employed personal loans are: a loan amount of up to $250,000 can be approved. Self-employed loans available from 10-30 years. People with bad credit are also provided with the loans. Both secured and unsecured loan options are available. Relatively fast approval of loans. Many people are self-employed these days, and to fulfill their requirements they need loans. With the introduction of self-employed loans, they are now more easily available in the market with attractive features as well, which helps them serve a lot of features as well to make the repayment easier and affordable for the borrowers.